Good morning, ladies and gentlemen, and welcome to today's Inside Track, hosted by your team here at Broll Auctions and Sales. My name is Keegan Oschger, and I'm pleased to bring you some valuable insight into the commercial property space today, with a special focus on the valuation and the inner workings of how to value a property. I've got an esteemed panel of guests here today. In the center, Prof. Kola Akansomi, professor at Wits University. He holds MRICS qualification and has a wealth of experience and academic knowledge. Prof, thanks for joining us today, appreciate it. Matt Counsell on Prof's right. He's a commercial broker here at Broll Auctions and Sales. He studied a BSc Property Studies at UCT. Great to have you with us here today. Also got great valuations experience. Thanks for coming through, Matt. To Prof's left-hand side is Jayson-lee Collins. Not unfamiliar to the TV screen. Jason's a sales support manager at Broll Auctions and Sales, as well as a commercial broker. Jace, thanks for coming again today. Yeah, looking forward to getting really stuck into the valuation process and how it goes about. Gentlemen, let's get stuck into the questions. Obviously quite an informal chat today, but I want to start with you, Prof. And coming from a theoretical academic background, how does one kind of link that theory to real-world practices?
Excellent, Keegan, and thank you for having me. It's a pleasure to be here on the panel. I think when we look at the theory of value and in terms of the practice, there's not much difference in comparison to other parts of or subtopics or subjects in real estate. Because when you look at the theory of value, right, it specifically looks at the net operating income. And when you capitalize it with a capitalization rate, you get the property value. And that's the basic income valuation of property. And that is what is usually used in the commercial real estate space. And I think when we look at it from the practical end, it's how do we measure the net operating income? And I think the challenge that most valuers would sort of experience on the field is how do we determine the capitalization rate? That is always a massive challenge. And I think that's the difference between theory and practice, because in theory, we can just literally look at maybe the SAPOA reports or look at the RODA reports and just sort of look at it like like an averaging, or look at it like an educated guess and estimate the capitalization rate. But in the real world, you need to go down, literally into the trenches, put your boots on, strap your boots on, go down into the field and actually do a lot more research, right, to be able to determine the capitalization rate. So when we look again, we look at theory, we look at practice, there's not much difference, right? But obviously in the real world, there needs to be more real life cases, more real life comparables or benchmarks to be able to estimate the capitalization rate. That is extremely important for us to determine value.
Yeah, I couldn't agree more. And that's one of the struggles I had as a student of yours, trying to determine that cap rate. I always used to come to you saying, Prof, like, we can't just base it on the SAPOA report, We need some real world examples. And, learning that now in the industry, you definitely need to have that experience, Matt. I think you can agree.
Yeah, I think, in all honesty, I think being on the ground, so I've kind of had the theoretical background from UCT. Then I went to work at a financial institution, and I did valuations there for just over 3 years. And then I moved to Broll Auctions and Sales, and I've been a broker. And it's been amazing to see how throughout that journey, like Prof is saying, it went from theory to then being at Nedbank, being a little bit more on the ground, also analytical, and then being at Broll Auctions and Sales, where we are every single day we're on the ground, speaking to clients and understanding where markets are at and the movements. And so I think being in the trenches has really been an experience which I feel has aided us in, if you speak to brokers now, I feel that they've got quite a comprehensive understanding of the market base. So we actually assist a lot of valuers who call us and ask us for market intel. It's a really good position to be in.
Yeah, it's a good relationship that asking a professional valuer who does that day in, day out for their insights, and then comparing it to the real world, auction platform, I think really does eke out the true market value of a property. We see properties going, 30% less than what the seller had in mind, but then you see a month after that, that's kind of the stock standard, and that's how we draw the line in auctions. I don't know if you can relate
Yeah,
to
no,
that.
I 100% agree. I think you guys nailed it on the head as well. I think the theory gives a good fundamental basis for the valuations. I think the problem we're seeing in valuations is the digital inputs. So especially with COVID now, we've seen rent reversions and things like that. And I think a lot of valuations are still overstated because the input into that theory isn't necessarily what the market is dictating. But I think you guys are spot on. Yeah, I think the theory gives a great fundamental basis, and the experience from the market gives you your accurate value.
Kola, how does the volatility in the market that we're experiencing at the moment, the uncertainty that we kind of as South Africans are experiencing on a day-to-day basis, power cuts, day 600 of lockdown, water shortages, the works. How does that volatility play into a valuation?
Excellent. Thanks, Keegan, for the question. What we need to realize in valuation is valuers enjoy predictability, right? So you want predictability, you want stability, and that's when we can. That's when prices can be determined, when the underlying variables behind it are predictable. And so when you have uncertainty, which is also volatility, it means unpredictability. It means the less of an ability for the valuer to forecast. And when that happens, it means there's going to be an issue with the pricing. Pricing is volatile, right? But obviously, it's a true reflection of the price. It just means that there's uncertainty in that price formation. And then once we come back to understand what has happened in the last 2 years, and how has that contributed to volatility in price formation, it's one, the COVID, right? It's a black swan event, right? Yeah. It happens one in a lifetime. It happens one in 100 years. I don't think we're going to see another event until we probably pass away, right? So, and so what that means is, and how has that had an impact on the volatility of pricing? With the lockdown restrictions specifically, right? Real estate is dependent on activity. It's dependent on people. It's dependent on usage. And once you restrict that usage, it has an impact on the real estate. I always compare real estate to a human, right? Humans need interaction, right? And once we don't get that interaction, we get depressed. And that's what happens in real estate. If real estate doesn't get human interaction, it gets depressed. It gets depressed in the form of rent. It gets depressed in the form of pricing, right? And that's how COVID has literally made that happen, uncertainty. And also prior to COVID as well, you must also recollect that South Africa has not been doing too well in terms of the economy, right? And so those have had quite lasting impacts on price formation and what we see in terms of volatility. And maybe we can just finally, Keegan, maybe also we can look at the markets. If we look at the indirect real estate and look at direct real estate, indirect real estate, you see that volatility happen quite almost instantaneously. And then there's a lag with direct real estate. It happens a little bit afterwards. But in summary, volatility, it's had an impact with the South African economy as well as COVID.
Yeah. Prof, sorry, just to cut you short there, can you explain to some of our viewers what indirect and direct real estate might be? We're not all associate professors at Wits, so just to like a basic layman's term version of.
All right, so when I mean indirect real estate, I just meant real estate investment trusts, right? Or we can say property development companies that are listed on the Johannesburg Stock Exchange, right? So basically what happens there is, the stock prices, COVID had an impact on the stock prices, right? Because because the markets there are quite liquid, it means that if I were an investor and there was certain external factors having an impact on my investment, I could quickly pull out. And that's what indirect real estates are.
Yeah.
You can pull out your stocks, right? You can sell stocks this minute or buy stocks this minute, and you can sell it off in the next 5 minutes. But that's completely different in commercial real estate.
Yeah.
As you know, guys, you guys are your brokers. You know, there's such costs involved. There's transaction costs involved, and so with direct real estate or commercial real estate, there's illiquidity, right? Which means you cannot just go in and come out and exit.
It's a long, extended process.
That's
It's
correct.
a long-term investment at the end of the day.
That's
Yeah.
correct.
And I completely agree with Prof regarding, and I love your analogy, relating property to people, because that is essentially what, drives the value. I mean, if I look at the simplest form in my mind of what is property, to me, it's a physical extension of people's wants and needs.
Yeah.
And therefore, once you understand people, once you understand their wants and needs, you can then understand property markets in a better way, and how well properties are aligned to those needs and wants will then determine kind of, like we were speaking about, predictability and sustainability of income. I think if you look at the markets at the moment, in COVID, there were a few types of asset classes which stood the test. They were resilient during this time. If you look at your neighborhood centers, for example, convenience retail, those were assets which were very much aligned with people's needs during the uncertain time of COVID.
Yeah.
Going to convenience, you're not in a big crowd, you're going to a pharmacy or a grocery store, and then also the logistics sector, if you look at that. If you look at a fund like Equitas, they performed well. If you look at areas like your Limborough Park area,
Yeah.
the developments continued during COVID. And I think that that's a factor of what's happened with COVID, with the changes in the consumer profile. People ordering online instead of going into the physical stores, and then the logistics hubs having to deliver stock. And then also looking at the tenant profile. I think in these big logistics hubs, you've got blue chip tenants who are on, some of them on triple net leases. So they are able to withstand the pressures of the market.
Yeah.
But then you look at the other asset classes, and I think you guys can feed into that, because I just think there you can see, like the office sector, for example, we all know it's experiencing pain at the moment. And that's because people's wants and needs are changing. Corporates' wants and needs are changing. And it's the adaptability of that, and then being able to forecast that. And I think one other thing, I think what Prof was saying was this direct and indirect investments. It's so true how an indirect investment, it's not as, it is liquid, but your direct investments, we're seeing it now. Our clients are coming to us saying, I don't have liquidity. My liquidity is tied up in my asset. And that's where the auction platform comes in, because we can deliver a service which is a quick, transparent process, and within 2 months, your property is transferred and the events happened, and so I think the auction platform is also very well suited to service that need in the market.
Yeah, for sure. And Jace, I think you can come in here speaking a little bit about the auction platform. How does that kind of align sellers' expectations and buyers' pricing? We've seen a lot of guys come in. The sellers are coming in at 2018 prices because they have a valuation from a financial institution from a few years back, and they're saying, sorry, this is the value of my property. I will not sell for less than this, And buyers are coming in wanting extreme discounts throughout the market. How does the auction platform align those?
Yeah, I think it all comes down to demand and supply. So especially with valuations, I think that valuations have been adjusted for due to COVID, due to these volatilities, these inconsistencies. But I don't think they've been adjusted enough, because I think the demand has also dwindled. I don't think there's the demand there that was there. I think there's still that demand, but just at different pricing levels, and that's what I was referring to with the input. So what the auction platform does is it takes all the buyers, it takes everyone in the market, and it lets them compete to the highest bidder who's indicative of the market price. If you have every single buyer that you possibly can, and that's what the campaign reaches to, if you have as many buyers as you can, you put them in the same room, whoever comes out on top is essentially the value of the property in that time. So I think that's where the auction platform comes into play. It's giving you a true indication of the market value. We're not reaching those valuations most of the times from valuers, but I think valuations come in many forms. I think you get valuations for insurance purposes. I think you get valuation for a bank might be different to a valuation done by us who sees it from the buyers and the demand in the market. So what we do is we facilitate that purchaser who's going to pay that price for that asset, and that's what we see the valuation as.
Yeah. And I think, people have spoken about the great reset of valuations and how the pandemic has kind of initiated that process. Prof, or Kola, how far do you think we've gone back in the market? Just as a general overview, maybe if you can give us in a number of years or even a non-quantitative kind of value.
Yeah.
I know it's a tough question of
it's a very, very tough question again. Again, real estate is a heterogeneous product, right? So it's not like the stocks, right? That it's quite similar. So obviously we need to understand what sort of market are we referring to. And if we look at commercial real estate as well, are we looking at an office space? Are we looking at industrial? Or are we looking at retail? And so to answer your question, let me just perhaps look at it from an office sector perspective.
Okay.
I think maybe that can assist in our discussion. Yeah. So for example, what we're seeing at the moment because of COVID is we're looking at about an average of, in terms of vacancy rates, right? You're looking at an average around South Africa of just over 15%, like about 15.4. So that was the last SAPOA report, which was just released about 2 weeks ago. And so that's about 15% vacancies. And we know how vacancies has an impact on valuation, right? Because, when we look at our pro forma, our cash flows to determine the value of real estate, vacancies as a variable reduces the NOI, the net operating income. And so that means when we then capitalize that NOI, would get depressed valuation. And the other time that we've seen such high vacancies in the office space, right, as far back as 2003.
Really? Yes.
So that's about, we're looking, 18 years ago. The last time we saw this sort of figures was 18 years ago, right, where in the office sector as well, the vacancies was around these figures. And right now, we're seeing a higher, in terms of quantity of vacancies, we're seeing a higher quantity as of today, present. Why? Because of also the supply. Between 2007 and 17, there's been an increase in, I think, about 6 million square meterage of office space in the market. And so if we look at it from a percentage point of view, yes, 2003 and now it's similar vacancies, but if we look at it from quantity, the quantity of vacant spaces, we're having more
it's a lot higher than
a lot higher, yeah.
I mean, Jace, you and I were still in primary school in 2003. We were still just out of nappy stage. But it's definitely.
Can I ask you something? When you refer to the vacancy rate, which has just been released now, does that take into account subletting? So for example, if there's a tenant who has rented a space, but they're not actually using it, so if to them it's vacant, so they actually then still subletting above that.
Yeah, that's interesting. To be honest, I'm not quite sure on the methodology that has been used by SAPOA, but they just tend to give a broad vacancy rates. But that's interesting angle as well, for us to look at to say, does it also take into consideration,
It's almost like there could be an additional vacancy even
Correct.
above that.
That's correct. That's correct. 100%. I agree.
We've seen a lot of tenants, sorry, Jay, that
right.
they're still paying their rent, but they're not actually in the office. So the office, they're sitting vacant, but they're treated as, occupied. And that tenant probably has plans to never come back to that office or come back to half of that space. So I think you can only predict an increase in the vacancy rate
Yeah.
in the near future.
Or maybe an alternative.
Yeah.
Because of social distancing, maybe guys do come back to the office, but they actually need more space to accommodate for their staff count and accommodate for different spaces in the office. I think it's a very kind of uncertain time right now. I mean, if I looked at, there was an article released now in London, how, okay, South Africa is obviously very different to London, but I mean, central London, their occupancies have picked up, and that was by virtue of the COVID restrictions essentially being reduced, and people being vaccinated and getting back into economic activity. So I think we're in a very, in a time where predictability, I think, like Prof was saying, is kind of, it's uncertain at the moment to call. But yeah, I think the office market is definitely the one that's showing a lot of stress, hospitality as well.
Yeah.
Again, COVID restrictions, people being limited, cross-border travel. And just going back to the office sector, I think something which was the flavor of the time has been this conversion, you know, and I think people need to realize that it's great to convert these buildings, but what the market dynamics around that? Is the additional supply needed? Like if you convert it to residential, for example, at what rate are those guys buying these offices? So if they were valued at, call it 8,000 to 12,000 rand a square meter pre-COVID, but now the market is where it is, residential conversion players are wanting to buy these buildings at 2,500, 3,000 rand a square meter, so that they can factor in their conversion costs and then still, you know, see a feasible project at the end of the day. And then that turns into us as brokers and then sellers as well. What are the sellers' expectations? Because if a seller's coming to us and saying, well, I've got this office block, it's been vacant for, call it 4 years, and then COVID came and made it even worse, they can't expect what the valuation said back, you know, a couple of years ago, because that's 8,000 to 12,000 rand a square. I'm just using an example, where the buyers are going to come in at a much lower rate. And we've seen deals like this happen. But again, can all these offices be converted to residential? I don't think so.
I think you have a lot of sellers that are still stuck on those 8,000 to 10,000 rand a square, and they're just going to ride the wave, wait it out. And I do think, you know, we'll eventually see an uptick in the market, especially the office market. There's always going to be, you know, demand for that kind of commercial space. And yeah, let's see what the 2022 and beyond holds in, you know, holds for us. Prof, you spoke about income capitalization and using the cap rate as a kind of true or a method of valuation. Can you tell us why it's important to not only base your valuation on one method of one methodology? So why is it important to use the sales comparison as well, and maybe a market through rate with your income cap?
Okay, I think, Keegan, yeah, thanks for the question. I think you've put me on the spot here because, you know...
or can, maybe you disagree. Can you only use the income cap?
Yes, so, you know, from a professional valuer's point of view, right, you need to use a certain, and like you can back me up here, right? You need to use a certain valuation technique for a certain, you know, type of property. And so you need to be very careful how, as a property valuer, you choose. You can't really pick and choose, right?
Really?
And you need to be very careful about that. So, for example, if I wanted to value an office space, right, I should be using an income method of valuation, and not maybe because I realized that maybe because during the COVID, the income method would be giving me a lower valuation. Then I say, no, I want to do a cost method because I know it's going to bump it up. So, you know, we need to be careful to say, look, you need to apply the appropriate valuation method and technique for a specific property type.
That's interesting. I didn't know that.
Yeah.
Because I know.
But maybe you can.
Yeah, and I think there's another. I mean, like with land leases, for example, I remember doing a valuation where I was advised to do a DCF method because the land lease had a short term, so we couldn't capitalize it into perpetuity. So we had to take that into account. So, like Prof saying, for certain properties, you know, you have to be sure that you're using the right method. But just in commercial property in general, the income capitalization approach has been the approach that has been utilized.
You see, I'm a bit on the other side of the fence here. And I completely hear where you guys are coming from, but from my opinion, you know, it could have been like that maybe pre-COVID. I think now with COVID, I've seen a lot of properties that I've realized on where it would be an income approach valuation. But my purchases, then we're talking about yields of 4%, and no one's buying at yields of 4%. But the property's upside held a lot more value than what the income was producing.
Yeah.
So I think that's where the whole discussion comes in on whether the theory is accurate or whether the market value is accurate. You know, those properties, we ended up selling them on a price per square because of the upside. And then again, in the theory, I mean, you could then argue that, okay, but then you have to project your income.
Yes.
But I'm seeing a lot of buyers hating buying properties on projected income because that creates a lot of uncertainty. Can you fill those vacancies? Will your vacancies ever be 100%? I mean, your occupancy ever be 100%? So I think that's where maybe a market value comes in a bit different, and that's what the auction platform does. It's not an income approach may say this property is worth 90 million, but it may only be worth, let's say, 60 million because you have to do the redevelopment, which comes back to your point in that whole commercial sector.
Yeah.
I think it's quite an interesting one. It's definitely a toss-up because I also kind of agree with Jason because that vacancy still holds some value.
Yeah,
and the income
100%.
approach doesn't account for that vacancy.
Well, you could apply a market-related rate to your vacancy.
Okay, then you are kind of ticking all the boxes, I guess.
But then again, you're projecting it.
Yeah.
So I don't think there's a right or wrong way. I just think that it's just different ways.
Right.
Yeah.
And a lot of times I think that they may even talk to each other, right? Like a sales comparison method and an income cap approach could essentially talk very similar values, you know? So it's also, you know, and I think with an income cap approach, you're looking like now, I think valuers need to be very cautious in terms of taking knee-jerk reactions now in this COVID time, where you say you reduce your cap rate by, 50 basis points or, 100 basis points. It's important to realize that maybe don't adjust your cap rate too much, but just look at the income, the cash flow changes, and the sustainability of it, and your tenant profile, and your vacancy or your escalation rates. So say traditionally escalation rates were at 8%. We know that escalation in rentals are remaining kind of stagnant at the moment. Landlords are wanting to retain their tenants. Tenants are saying they're under pressure, so the landlord's having to work with them. So when you apply it, do you apply a flat escalation where there is none, or maybe just a softer escalation, say 3% instead of 8%? And I think that's the thing about valuations. It's an analytical tool, and each property is going to be different.
Yeah, definitely.
Sorry, Keegan, just to comment in as well, right? We also have to understand that, when we're looking at this from, the auction platform, right? We perhaps be looking at it from an investment value. And investment value is completely different from a valuer's method of income valuation, because that's why you'd see that if you had a bunch of 20 investors come into this room and they're particularly bidding for a particular property, in their mind, they know what their investment value is. And each of that 20 investors would have different investment values, right? And that's why when they bid, at some point, in your mind, someone would overbid. So, Jason may have his own value, and Keegan may have your value.
Yeah.
Sometimes, Jason can stop, right? Because that's his investment value. He's done. But Keegan, you can continue bidding, right? Because your investment value is not the same as Jason's investment value. And so that's what we need to try to understand, that when we're looking at it from an investor's perspective, value is not homogeneous, right? Right? Isn't it? So that's what I just wanted to draw upon. And also you have to understand that different investors have different risk appetite, right? Then also different investors have, in terms of, their financing. Some investors are coming in with 100% equity. Some investors are coming in with debt. So their perception of value is completely different.
And have
So
to factor all of
it's an
those factors
opinion.
in.
Yeah, yeah. It's, You know, there's so many factors, right? So we need to be careful that when we talk about market value or valuation from a professional valuer's perspective, it's different from an investor's perspective
And I
of
think
value.
feeling and sentiment comes into a lot more into investment values.
That's correct.
Kind of end value, because that investor may love that property,
Right.
but the market sees it as almost worthless.
That's correct. And even the required rate of return, right? There are premiums. How do we determine premiums? My premium, for example, a nice property in Cape Town, right? Maybe I have, like you said, sentiments to it, right? The way my premium for that property would be different, right, from someone else's, premium on it.
Yeah.
And that's why you'd see, and that's a perfect platform for auctioning, because
Exactly.
that's when
you want that feeling coming in, and that sentiment.
And that touches on that point I was saying earlier, even in valuations, you got different values for different things. You've got values for replacement costs. You've got values for insurance. You've got values for an investor. So, so you just kind of need to be a bit aware as the person working with the valuation as to what that valuation was targeting.
Yeah, for sure. And I think that's why the BSc Property Studies degree at WITS, and as well as UCT, but with our special focus on WITS, with our ongoing relationship with you guys, and the newfound kind of chapter that we're both experiencing and we're stepping into, that base of valuation and the theoretical background plays such an important and integral role going into the real world, because you need those basic pillars to kind of utilize in the real world. And I think that's why the partnership with WITS University is really a step in the right direction for both Bro Auctions and Sales, as well as WITS, getting that experience into the market. Matt, touching on, Matt and Kola's points, we actually had a buyer in our previous auction. One of the properties was an old bank site, and he actually grew up in that house, back in the day. And he held that sentimental value, and he was actually the highest bidder, by a long shot, because that sentimental value, it was his childhood home. All his memories are in there, and he's buying it in a small town in Lindley. He'll use it as kind of a getaway spot, and that's way above market value in our opinion. So quite interesting, actually.
Yeah.
Matt, can you tell us a little bit more about the stock that we have on this next auction? What's the
I think there's a range of assets like there always are. We've got some retail properties that require vision. So somebody's got a sentiment to unlock. We've got an amazing site in Randburg, close to the taxi rank, but it just needs to be somebody with a vision needs to come in and unlock that value. We've got commercial buildings in Pretoria CBD, great locations. And investors can look at them and see where they can unlock value, whether that's for conversion, whether that's because they've got a government tenant or a commercial tenant, and then there's other retail sites like industrial properties. We've got something out in, we've got retail in Potchefstroom, outlying town. We've got a bank, Absa Bank facility right next door to it. Very unique opportunity to buy two properties right next door to each other. It's like a wholesaler, retailer. So it's both around 2,000 square meters each. With the auctions, we've got a range of assets across the country. And that's what I love about Bro Auctions and Sales, is that we aren't limited geographically. So the assets which you can get are in the Western. We've got some stuff in the Western Cape, in Long Street, and these assets would rarely come to the market, right? But because of the situation that we find ourselves in, and like we were referring to earlier, maybe it's liquidity, everybody's different. But these opportunities would rarely come to the market, and now they're here. So it's our investors seeing the opportunities which exist. And if they do, it's the best time for them to buy and get involved.
Yeah. I know you know Long Street all too well.
used to. Past tense.
Jay, what's some of the stock that's coming up for you?
Yeah, look, I mean, I've got a fantastic property in Elroad. International client of ours, huge, over 19,000 squares. I mean, it's tenanted. There's about 12,500 squares of that 19,000, but it's still making a 3.8 per annum gross rental. So we've got that on the market. We've got fantastic commercial, iconic property in Nelspruit. We've also got on the other side, we've got a small, nice little smartie in Pretoria CBD on an intersection of Boom and Blood, bordering a taxi rank, perfect for an operator, someone looking to make some nice returns, someone looking for high foot exposure, something like that. Like Matt said, I mean, we've got an array of properties. I mean, we've got pretty much everything for everybody.
Yeah.
So,
that property in Atlas Road really, speaks out to a big, heavy industrial player, someone who needs some exposure in the country. And I think you're going to get an international buyer, is my feeling from there. It just suits it so well. Massive crane manufacturer. So you're looking forward to what you get on auction for that
likewise.
one.
And I mean, the one property in Church Square. You go to Church Square and you look at the views from the rooftop. It's unbelievable. And the fact that we've got that property on auction, it's a privilege. Because it's a piece of real estate that has been there for generations. And again, that would never, ever be on the market if it wasn't for where we find ourselves now. And now is the time for investors to get involved. The 5,000 square meters, for example, to just come in and put their hands up. And I hope you don't mind me kind of changing the topic a little bit. I just wanted to ask Prof, I've been looking at, one thing that I have noticed is municipal valuations that are sometimes
the reaction.
that are sometimes well above, where the market's talking. And because of that, what we're seeing is some rates and taxes are much higher because the rates and taxes are a factor of that municipal value, right? So sometimes the municipal value, or the municipal rates, are higher than where I feel they should be from a market-related basis. So I think the question is, like, have you seen that with your valuations, and kind of what are your thoughts on, it's not, I won't say it's in general, like all the time, it's just some properties I'm starting to notice that municipal values aren't necessarily aligned where we kind of predict value to be.
Yeah. All right, thanks, Matt. I think to be honest, municipal valuation is not my forte, right? I'm more of a commercial real estate guy and more of a real estate investment trust person, right? But I think so this is my hunch, right? I think it may border on information. And I think information is very important for value. And so I think, again, who has the right information and how is that information being used, right? So I'm not sure how the municipality gets their rental values, their expense projection, or or how they determine value as such, right? Because from a commercial point of view, we're looking at value as, you're looking at it based on your income. It's all income driven, right? And it's something that you can observe. It's very observable, right? So what, as a commercial property owner, right? You're seeing your rental flows, right? You know when you have vacancies, you know when you have occupancies, you see your expense roll, everything is in real time, right? But the municipality doesn't have access to that information. So at some point they then need to forecast, predict, assume, exactly. They make assumptions. But is their assumption, does it match reality? That's another question, right? So, and then we know that valuation is sort of is an opinion, and there is errors in valuation. So, it's very difficult for me to, as an outsider, to say why is it so are there so huge discrepancies? It's very difficult for me as an outsider to say, but my hunch is information. I think if maybe the municipality and property owners, maybe it could be with the SAPOR or a property organization, they need to come to the table and speak and have a dialogue to understand, why is it that your values and our values are not seeing eye to eye. Let's bring our figures out, let's talk, let's dialogue. And I think that's the only way that you can sort of solve this sort of impasse, right? Because no one wants to have, because obviously when you look at high property values, when property values are maybe overstated, I'm not sure, it has an impact on property tax. The higher the value, the higher the property tax, which then is beneficial for obviously the municipality, right? But I think when there's sort of an impasse like this, people need to come to the table and have a dialogue as to understand why there's sort of these discrepancies. But I'm not sure if Matt, you want to come in, or also Jason as well.
Yeah, I just have one question, and it's a bit of a devil's advocate here. Do you think that when we are seeing those overstated municipal values, do you think that could be a strategy to kind of bring in more income for the municipalities, or do you think it's maybe just a discrepancy in two valuations, two different opinions from two different valuers?
Yeah, I mean, it's difficult for me to comment, right? Because, like I said, I'm an outsider as well. Yeah. I'm an outside person, right? So it needs the two parties to sort of, like I said, it needs more discussion around this. Let's see what figures are you using, or what cap rates are you using, and what you have to also understand is that when municipalities sort of determine their value, sometimes it's based on maybe 5 years. Sometimes they use what you call mass appraisals.
Yeah, mass appraisal techniques.
Right, mass appraisal techniques, which is not the same thing as. Remember, now they're dealing with, for example, they look at residential properties. They're dealing with millions of properties. But then there could be some discrepancies in the model. The model may not pick up that little or that property in Houghton. That is just one property from a million of properties. Right. So sometimes as well we need to understand with those models also have errors in them. I mean, look at the story of there was this Zillow, right? Zillow, the property Zillow is a property. They do property valuations in the US, right? Yeah. And they also had errors with their AIs. They lost about $500 million. Yes, about just about there's a recent article about 2 weeks, 3 weeks ago. Okay. They were using AIs to predict property values, and they then buy that property to flip it over. But what happens was the AI, because of COVID and everything, the model was overvaluing the property. So they buy it, it's overvalued. They buy it, they're trying to flip it. But then the market they can't make it back. So my point as well is let's also be a bit more pragmatic and not be so, not to be so, when we look at there could be errors in valuation. So I'm saying models, AI technology, models as well, they're also susceptible to errors, right? Sure. And that's where it can.
And that's why you need that human input. All the time,
100%, absolutely, and that's what the role of valuers is very, very important, right? Because, and I think that's why you need property valuers. Yeah. Because it's not AI, it's not modeling, right? It's understanding. Because again, the valuer or the broker is right on the ground. For example, you guys in Bro, right? You are right on the ground. You understand the market. You understand the nuances. Sometimes AI is a model, they can't pick that up.
Sure. Yeah. And I think that's also quite what the supplementary valuation role and the appeals process. That's why it plays such an important role, because if you do see that your property may be overvalued, you can go to the municipality, and they often do, at least look at it and sometimes correct it to true market value.
Yeah. And I think what Prof was also alluding to is you were saying collaboration, synergies. And I think that it even goes down from a town planning perspective. As you look at these the town planners, the use of the property. So when you look at the highest and best use, if you're sitting with a commercial property, but you don't have the rights to be innovative and kind of change that up, looking at the land use planning schemes in Johannesburg or Cape Town or Durban, how are these land use schemes planned, and then are brokers aware of them? Are the market aware of them? Because if you are, all of a sudden these opportunities come alive, because then you can see. And then how flexible are those town planning, call it the town planning departments within these municipalities? How flexible are they in terms of accommodating developers' innovation, going forward? Because we're realizing the market's changing, right? Yeah. We're in a time where, geez, if you've got a vision for something and you can unlock it, but do you have the rights on the property? And what is the process? How long is it taking to kind of unlock that value?
Yeah. Kola, I just have one more question for you, and then I think we can start wrapping things up. Obviously, you sit on the board of the SA REIT Association Research Committee, and you kind of have an inside track to where REITs are kind of going and where they're trending towards. Have you got any insights to share with us, some insider information maybe to where the REITs are trending?
All right.
If you have.
I'm not sure I have any insider information, but I think if we look 2 years ago, right, in terms of, if we look at the SA REITs index, the position where it was, and then obviously if we look at the impact of COVID, right, so when we looked at around April, March to April, right, when COVID impacted, you were looking at like half of the index was completely wiped out. Obviously, had an impact. COVID really had a massive impact on real estate and the listed market, right? And so what we're seeing now is that with the vaccination programs in South Africa, which has rolled out, we're looking at 25% of the South African population is now vaccinated, and quite a number, it's about 14 million people. And then we've seen that quite a number of people are now being more, there's more activity. As you can see, there's traffic now. When if you go in, Joburg traffic is back, right? And you can see that the economy is back. People are, economy is even picked up as well. During the COVID, we had, and real estate actually it depends on the economy, right? So if we look at 2020, REITs really did quite badly. And also look at the GDP as well. South Africa GDP, I think, reduced -7%, right? So all those have had a massive impact, right? The economy not doing well, the impact of COVID restrictions, obviously had to have, there's no way that it wouldn't have an impact on the REITs market, right? And you can look at it from the REITs index. But what we've seen in 2021 is a recovery. And we're now seeing that if you look at the REITs index as well, in 2021, I think it's recovered as high as going back to almost 25 to 50% recovery back of the index. So we can see that quite a number of REITs are now recovering. We're seeing like higher occupancies. We're seeing like more rentals being collected, right? And that obviously has an impact on the performance of the REITs. And so I think going into the future, we also have to understand that the REIT markets as well is quite segmented, right? So we have different, for example, Matt talked about equities, right? Which is doing very well. They're obviously in the industrial space and they're doing excellent, right? And so we also understand that different REITs within that the stock exchange would perform quite differently. But obviously, if we look at it collectively, 2 years ago we're doing quite okay. Then COVID hit, a massive fall in the REIT prices, but now they're also picking up. And I think going forward to 2022, and again, this is my hunch, right? My advice is I'm not advising for anyone to buy any REIT stocks or whatever, but I think the only way is going to be up, right? Okay. Because 2020 was one of the worst years for REITs, right? Yeah. But you can see the trajectory 2021. It's going up, and I think 2022 as well. I think we can see the recovery in retail. Obviously, retail is not where it should be. Obviously, with terms of retail and malls, average vacancies used to be around 3.3%. Now it's sitting at 6%. Sure. So there's So, but we can but things are coming back. Then we look at office space as well. We're seeing vacancies of 15%. With that sector, we're quite unsure. Industrial space, is looking good. So I think generally, we're looking at recovery, but also we also need to look at different types of rates and understand that there will be different impacts across.
Each
across
REIT
board.
has different inputs and
That's
different
correct.
factors. Matt, any concluding remarks regarding that or anything else?
Yeah, I think one of the things is to, I think it was with Prof. Sam Azazu. I'll never forget what he said to me. We were having a discussion around property markets and the maturity of them, and how some markets, and call it a few decades ago, call it infant markets. And in that sense, it was you could build a building and people would come, and use the building. Now we're in a maturing market, and competition is there. Supply has increased, and I think it's therefore even more important to understand how these asset classes are having an impact on each other. Like what Prof was essentially saying, from what I took from it, is understanding when you look at a REIT, what properties or property types is that REIT backed by? So Equitas Industrial. Okay, well, then you can see and gauge where that's going to move and go. But I think it's understanding the life cycle of where we're at. In summary, we're in a maturing market, but we're in a very uncertain time. That uncertainty also provides a lot of opportunities. And yeah, I think just going forward, it's all about, in my mind, it's about innovation. It's about not giving up. It's about believing in our country. It's about believing in the future, and realizing that if we come together from a public sector, a private sector, we need to work together and collaborate more in order to really unlock the true value that exists in our country. But it's up to us. And what are we going to do? That's the question. What are our children going to say to us, or our grandkids going to say to us? You were involved in this time, this Black Swan event. What did you do in that Swan event?
Sure.
That's the statesman.
Well said, Matt. Really. Yeah. Jayson, any concluding remarks?
Yeah, I think my input there is that I think we're going to see a lot of increase in values over the next 5 years. I think just from speaking from the market, I think sentiments has changed. I think we're pretty much near the bottom of the cycle. I think it's going to go up. I share the same sentiment with you, Matt. I think it's up to us to now kind of capitalize on these opportunities. I think the market's going to recover, and I think we're already on the way up.
Yeah.
So I'm looking very forward to the future. I'm feeling very optimistic about it. And I think we're going to see a lot of great opportunities come to life.
Yeah. I mean, I agree with Jayson. I think the best time is right now, right? The opportunities are there. Abound.
Yeah. I think we can wave that rock bottom goodbye and hopefully look up for 2022 and beyond. Got a very exciting auction up next week Thursday at the Wanderers Club. Really looking forward to what stock moves and what stock doesn't. It's always a good gauge on where the market's going and what asset classes the market is appealed to. Got a beautiful retail portfolio in Bloemfontein. Just want to toot my own horn quickly. Netting about 3.67 million per annum in the CBD. I think that one's going to fly. Let's hope. Prof. Kola, thanks again for joining us today. Always appreciate your inputs and your insights. And we hope we can do this again with you quite soon. Good luck with the exam season back at Wits. I'm sure the students are stressing and studying at the moment. One can only look forward to 2022. Thanks again for joining us today. Really appreciate your views. And come join us at the auction next week Thursday, Wanderers Club at 11 a.m. Thanks again. Cheers.